We're here in Monte Carlo for the Rendez-Vous de Septembre. For Invest TV, I'm Richard Banks. And I'm joined now by Rob Bredahl, who's the CEO of TigerRisk Partners. Rob, welcome.
Thanks for having me.
The global economic situation is the top of the agenda here for people in Monte Carlo this week. What are the impact of rising inflation and other economic difficulties on the reinsurance industry?
So it is the talk of the get-together. Inflation and the resultant increase in interest rates is having a huge impact on both the supply and demand side. So on the supply side, the increase in inflation is increasing TIVs. So carriers are just going to have to buy more coverage, more limit to cover the same units that were covered last year because of inflation. So demand's going to be up. It's going to be up noticeably. Then on the flip side, because of the increase in interest rates, there's very large mark-to-market losses in investment portfolios. And so I've seen estimates where committed capital for the reinsurance market could be down as much as 10% because of mark-to-market losses. And also the economic environment has also hurt equity markets. So there's also a drop in mark-to-markets due to equities. And so supply down and demand up doesn't bode real well for pricing next year for renewals.
So you as a reinsurance broking organization, that presents some challenges. You're an atypical reinsurance broking organization. Tell us about some of the opportunities that you see.
Well, I think the biggest opportunity, one, is to do a better job placing cat risk in a difficult market for our clients. So, what is that? Getting out early, always having a backup plan, involving the senior people in the company who might have different or better relationships. So there's lots of just very basic blocking and tackling that needs to be done. But we're really the only broker that has I'll call it a real investment bank. We have a leading P&C focused investment bank. And so we've put a SWAT team together to go out and scour the world to find cat capacity in all forms. And so that's new companies, startups, rated companies, raising money for ILS funds, sidecars, FAL for Lloyd's entities. We're also going out to life companies, regional companies, anybody that might be able to help with this capacity issue in the market.
So what sort of response are you getting? What's the appetite from investors?
It's tough. We're making progress. And I'll just bucket a couple of categories. Private equity, who in past cycles in 93, 2001, 2006, who came in to form new companies, rated companies, we are not seeing much interest, and that's because the value or the valuations of rated balance sheets are somewhere near an all-time low. They're somewhere below book. It might be 80% of book on average. And so the old equation was, private equity come in at book value, there's management carry expenses, so maybe you end up at 1.15 times book, but look at where established companies are traded. They're trading at 1.4, and so IRRs after you exit will be very good. Today, it's getting at 1.15 on a new company, but no confidence in where the exit will be. And so I don't expect new rated private equity sponsored balance sheets, and that's what's very different in this cycle versus other cycles. And so forms of capacity that are self-liquidating, like an ILS fund where you get in at book, come out at book. Lloyd's FAL, I think, is a good investment because there's a set process and infrastructure to allow investors to exit. Those forms, more collateralized, self-liquidating forms, I think is where the capacity is going to come from.
And is there capacity available? I mean, are people picking it up?
Some, and there's a lot of waiting and seeing going on. One thing we hear from investors is that yes, the cat market, we see prices are up. That looks pretty good. It looks very good relative to where the market was a couple of years ago, but because of the sell-off in a bunch of financial markets, some dislocation, my opportunity set's very big. And so now I need to figure out, does that rate relative to other opportunities?
So there's more competition for that capacity?
More competition. So it's the relativity, of course. So yes, writing cat is more attractive, but how does it rate compared to other alternative asset classes? And I think I'm concerned I'm sounding too negative. We are making progress. New capital will come in, and that's just how markets work. Prices go up, and more capacity, fills the capacity void. So,
amid all that, people are starting to talk about a genuine hard market. Now, a lot of people who are operating in the market today won't have experienced that before. They won't have experienced high interest rates either, of course. But what are the things that we should be looking out for? Where might the surprises come?
In the hard market, maybe a little historical overview. So there was a period around 06 to 16 where there wasn't a major hurricane landfall in the U.S. And I heard it described as a 1 in 100. Like that's very unusual. And so a lot of money was made on cat. And so now we're in the fourth year or so of price increases, but we're still not back to the 2006 level. And so we might get there. But just to put it in perspective, relative to recent history, pricing is not horrible. Because of the issues around valuations, I do think this harder market could continue. Rates up at a reasonable rate for multiple years where everybody can react to it, I think is far better than some very big spike that dislocates companies.
History lesson is always welcome. One of the criticisms that's often levelled at the insurance industry is it's very good at looking backwards. It's very good at solving the last problem. How does it get on the front foot and perhaps address some of the problems that are coming up?
Yeah, I hear that criticism a lot, but the disasters or big events are very low probability events, and so there's just not a lot of data on it. And I actually think the industry has done and does a lot. They're trying to come to grips with climate change. They're adjusting models, using technology all over the place to help underwrite and adjust claims, satellites, drones. And so cyber is another good example. Very difficult class to underwrite. An enormous amount of money is being spent by primary companies to understand the cyber risk, to provide hardening services to entities. And so the premise that the industry hasn't done enough or looks back instead of forward, I'm not sure I fully agree.
Rob, thank you very much indeed for joining us today.
Great. Thank you.
For AM Best TV, I'm Richard Banks.